Welcome to the Dept Dive. Today, we're really getting into the weeds with some source material from a recent earnings call. We're looking at Eagle Materials.
Right, Eagle Materials. They're a big player in the U.S., building materials, cement, concrete, aggregates, gypsum wallboard, that kind of thing.
Yeah, the essentials. And diving into their earnings call, it really gives us a direct look at how management views things.
Exactly. Performance, strategy, challenges, it's all there, straight from them.
So our mission today is pretty clear. Unpack this call, pull out the key stuff, figure out what really matters about their recent performance, their plans, their outlook, all based on what they actually said.
Think of it as the highlights reel, the stuff you really need to know about what Eagle's up to right now.
Okay, let's start with the big picture then. Fiscal year 2025 performance. The headline, records.
That's right. Record revenue for the fiscal year, hitting $2.3 billion. And record earnings per share, too, $13.77.
And that wasn't just a one-off good year, was it?
No, what's really striking is this is the fourth year running they've hit record financial results, 4 years straight.
Which is pretty impressive given, well, all the chatter about the economy. They mentioned that, didn't they?
They did, yeah. They framed it as achieving this despite, quote, day-to-day headline noise surrounding the economy. So it's just some real resilience there.
And that earnings per share number, the $13.77, how did that come about? Was it just higher profit?
Well, partly, but a big helper was their share repurchase program. They've been buying back their own stock, which means the total number of shares goes down. So the profit gets spread over fewer shares, boosting the EPS number.
Ah, okay.
Yeah. Their share count dropped 4% this past year alone. And if you look back 5 years, it's down a pretty significant 20%. That buyback impact more than made up for a slight dip in actual net earnings for the year.
Got it. So solid results overall for the year, but they spent quite a bit of time on the call talking strategy, right? This idea of investing through cycles.
Yes, and that's, I think, really central to how they operate. It's not just about reacting to today's economy, which, might feel a bit uncertain.
Right.
It's about making these deliberate, long-term investments that they believe set them up for success down the road, no matter the economic ups and downs.
And they connected that long view thinking to being diligent everywhere, even starting with safety.
Absolutely. They made a point of highlighting their best ever safety performance, their lowest TRR, that's total recordable injury rate, in company history.
That's significant.
It is. And alongside that, a 25% jump in hazard reporting.
Uh-huh.
So people are actively spotting risks. They're rolling out a new safety program, too, called Eagle Safe. Seems like a real focus.
And that diligence, it carries over into sustainability, too, but with a practical edge.
Yeah, exactly. They talked about projects that aren't just, green initiatives for the sake of it, but ones that deliver real economic benefits and environmental ones.
Like what?
Well, there was a $22 million upgrade at a paper mill.
Yeah.
Cuts water use by half, saves energy. Or projects at cement plants using recycled tires as fuel. That lowers their fuel costs and reduces CO2 intensity. It's efficiency and sustainability working together.
Okay, so efficiency, safety. But the big money, the investing through cycles part, that really showed up in their expansion plans, right?
Oh, absolutely. This was a major theme. They're putting serious capital into growing capacity and reach.
Where specifically?
Okay, so in aggregates, that's like crushed stone and gravel, they spent $175 million buying 2 companies. That boosted their aggregate production capacity by 50%. And they said these fit really well with their existing network, integrations going well.
50%, wow.
Yeah, big jump. Then in cement, they just commissioned a new slag facility down in Texas. Slag's a byproduct from steelmaking they can use in cement. That'll ramp up this year.
Okay.
But the really big cement project is the expansion up in northern Colorado at their Mountain Cement plant. That's apparently on track, on budget. The major spending for that starts next fiscal year.
And what's the goal there?
Another 50% capacity increase for that plant. Plus, big energy efficiency gains. They're targeting like a 25% cost saving on energy there.
And they're not stopping there, are they? Wallboard too?
Nope. A huge investment announced for wallboard. $330 million to modernize and expand their plant in Duco, Oklahoma.
$330 million is serious money.
It is. And the key there is they have their own natural gypsum reserves right there, which is a big advantage in wallboard. They're putting in state-of-the-art tech to really push their low-cost position.
And location matters.
Definitely. Yeah. That plant's well-placed to serve growing markets in the South and Southeast. Startup for that new line is planned for the second half of calendar 2027.
Okay, aggregates, cement, wallboard. These are massive projects. Did they explain like their philosophy for choosing these? How do they decide where to put the money?
They did. They focus on assets and markets they know really well. And they have strict financial criteria. They're looking for projects that hit an internal target of 15% cash-on-cash return after taxes.
15%. Okay.
Yeah, so high return opportunities that also strengthen their competitive footing in growing areas.
Yeah.
And crucially, they stress that because their balance sheet is strong, they can fund all this without stopping M&A activity or cutting back on returning cash to shareholders.
Right, because they did both last year, didn't they? Acquisitions and shareholder returns?
Yep, over $175 million on those aggregate acquisitions we mentioned, plus $195 million in other capital projects in fiscal 25. And they gave back a lot to shareholders.
How much are we talking for next year's spending with these big projects ramping up?
It's going to jump. They're projecting total capital spending for fiscal 2026 in the range of $475 million to $525 million, mostly driven by that mountain cement expansion and the Duke wallboard project.
Wow, okay. $500 million.
Yeah. But even with that massive investment plan, they still returned $332 million to shareholders last year, $34 million in dividends, $298 million buying back stock.
And they still have room to buy more.
They do. Authorization for another 4.7 million shares. And their debt level, their net leverage, is only 1.5 times their core profitability. So they have a lot of financial flexibility, even with this spending.
Okay, so the full year picture. Record results, huge investments underway, strong balance sheet. But the last quarter, Q4, wasn't quite as strong, right? There was a bit of a dip.
Yeah, Q4 was a bit weaker. Revenue down 1% from the year before, EPS down 11%. Though if you adjust for some one-off things, it was more like down 7%.
What caused the dip?
The main culprit was weather. Particularly bad weather in February really hit their cement and concrete aggregates volumes, caused production interruptions, that sort of thing.
Weather. Always a factor in construction.
Always. And they actually used some of that forced downtime kind of strategically to pull forward some annual maintenance they had planned for later at one of their cement plants in Texas.
Okay, so they made the best of it. Were there costs associated with that?
Yeah, they estimate the direct hit from the weather downtime was maybe $4 to $5 million. And then changing the timing of that maintenance, plus some costs related to starting up that new slag facility in Houston, impacted their joint venture results by about another $4 million.
Any other one-offs in Q4?
There were also about $3.4 million in costs tied to the acquisitions they made, hitting the books in that quarter. So you add it all up, and their heavy materials, segment cement, concrete aggregates, saw operating earnings drop by 50% just in that quarter.
Ouch. So Q4 was choppy, mostly weather and timing things. But looking past that, how are they feeling about the underlying demand for their stuff?
They sounded pretty confident, actually. Said they believe the fundamental demand and supply situation looks favorable across all their businesses.
Okay, let's break that down. Heavy materials, first cement, concrete. That goes into infrastructure, big commercial projects. What's the outlook there?
They're not seeing any big disruption in funding for public infrastructure projects. In fact, they said their customers are reporting healthy bidding activity.
So the infrastructure bill money is flowing.
Well, they did say it's been very slow to materialize. Apparently, less than 35% of the allocated funds have actually been spent so far. But they are seeing volumes pick up again in March and April as the weather improved, which is encouraging. And they expect that infrastructure spending, supported by both parties, to be a tailwind for cement demand for several years.
What about other non-residential building, like warehouses, factories?
That's a smaller piece for their cement business, maybe 25%. But it includes these big multi-year projects. Think data centers, manufacturing plants. They expect that part to be a pretty steady business.
Okay, that's heavy materials. What about light materials? Wallboard that's tied to housing, right?
Very much so. And the housing market, well, they described it as being kind of stuck in the same place it's been for a couple of years now, meaning high mortgage rates, affordability challenges. Those are definite headwinds for building new single-family homes. But, and this is key, they firmly believe the U.S. is fundamentally underbuilt. There's a huge underlying need for new housing, a lot of pent-up demand.
So they think it has to come back eventually.
Exactly. They put it as a matter of when, not if, single-family construction rebounds. But for right now, they're expecting home building to kind of stay where it is, which keeps wallboard demand range-bound, stuck in a relatively narrow band.
And with demand maybe range-bound for now, but potentially picking up later, is a lot of new supply coming online from competitors.
They don't think so. They believe significant capacity constraints are going to persist, both in cement and wallboard. over the medium term, which means even at current demand levels, factories are running pretty full.
Eagle is purely a U.S. domestic company. Do import tariffs affect them much?
Not really,
Yeah.
according to them. They pointed out wallboard and cement from Mexico and Canada are excluded from tariffs. For imports from elsewhere, the tariffs are generally low, maybe 10%. And once you factor in shipping costs, the actual impact per ton on something like cement is pretty small. They estimated maybe $4 to $6 a ton. So not a major business impact for them.
Got it. So looking ahead, costs like energy can bounce around. How are they thinking about profit margins? Can they keep improving?
Well, they noted the current quarter, April, May, tends to have higher costs because it's maintenance season for many of their plants.
Yeah.
But looking at the full year ahead, yeah, they think they can improve overall margins, particularly if cement volumes recover like they hope.
And wallboard margins.
They described wallboard margins as attractive, even at current home building levels, which are, historically not that high. They've gotten some help recently from lower natural gas prices and ocean freight costs, too.
So decent now, but potentially much better if housing picks up.
That's the long-term view, absolutely.
Right.
They see significant room for margin expansion when home building really recovers. They pointed out that historically the market shipped way more wallboard, like 36 billion square feet, compared to maybe 28 billion now. So there's potential upside.
Okay, sometimes the really interesting nuggets come out in the Q&A with analysts. Anything jump out there? Like, what about that operating loss in concrete and aggregates in Q4? That sounded bad.
Yeah, they addressed that. Said it was largely a one-off accounting thing, mostly purchase accounting adjustments and depreciation charges related to those acquisitions they just closed in the quarter.
So not really reflecting the underlying business performance.
Right. Management basically said, look at it on an EBITDA basis, earnings before interest, taxes, depreciation, amortization to get a clearer view. And on that basis, they're pleased with how aggregates are doing and how the integration is going. Remember that 50% capacity boost.
Okay. Any other sort of one-time costs or things analysts should be aware of for modeling next year?
Well, the purchase accounting impact was mostly contained in Q4 fiscal 25, but they mentioned costs related to implementing a new company-wide software system, an ERP system. Those will continue into fiscal 2026. So they guided analysts to model corporate SG&A costs at about the same level as the year just ended.
And that huge Duke wallboard project building the new line won't disrupt the existing ones.
Correct. They specifically confirmed the existing lines will keep running right up till the new modernized line is finished and ready. Same approach they're taking with the mountain cement expansion build alongside, then switch over.
Makes sense. And one more from the Q&A M&A. Are they still looking for more aggregate deals after those big buys?
Sounds like it. They said they're always looking at aggregate deals, though the pipeline sort of ebbs and flows. They see themselves as historical buyers in that space and will keep looking as long as deals fit their network, hit their financial return targets, and benefit the whole system.
Okay. And lastly, there was some other news, right, about the board.
Yeah, just a governance note. They appointed a new director, David Rush. He's the retired CEO of Builders First Source, another big name in building material supply. So brings a lot of relevant industry experience to their board.
Okay, let's try and connect all these dots then. What are the key takeaways from this deep dive into the Eagle Materials call?
Well, you've got a company that just posted a record fiscal year, number 4 in a row, showing resilience despite economic uncertainty. Strong pricing, efficiency gains were key.
But they did face some headwinds recently, especially in Q4 with weather and ongoing housing affordability issues impacting volumes.
Right. But the big story, I think, is their strategic focus.
Yeah.
Investing heavily through these cycles. They're pouring capital into major capacity expansions and modernizations, aggregates, cement, wallboard.
And they're doing it from a position of strength with a solid balance sheet that lets them fund these huge projects while still looking for acquisitions and returning cash to shareholders.
Exactly. They're betting on the long game, really. Betting that underlying fundamentals like infrastructure spending and the basic need for more housing in the U.S. will eventually drive growth, especially when things like interest rates maybe become less of a drag.
And the material suggests they feel well-positioned competitively, especially with things like their gypsum reserves for wallboard, the modernization plans, and their track record of integrating acquisitions.
Yeah, that seems to be the narrative. Strong core, investing for a future they believe in.
Okay, so as we wrap up, here's something to think about. Eagle Materials is making these really significant investments now, expanding capacity across the board, while management themselves are talking about constrained supply in the market and pent-up demand just waiting for better conditions. So how might that strategic positioning, investing heavily before the turn, allow them to potentially capture outsized benefits once the market eventually does improve?
That's the multi-billion-dollar question, isn't it? It really highlights the potential payoff for patience and strategic investment during uncertain times. Definitely something to chew on when you think about this sector.
And just a reminder for everyone listening, we're breaking down the information from the earnings call here. This is purely for informational purposes.
That's right. It's definitely not financial advice. Always do your own homework before making any investment decisions.
Absolutely. That concludes this deep dive.
Thanks for joining us.